Morning, everyone. We're just waiting a few minutes for everybody to join up, and then we will begin shortly. Thanks. All right, guys. I think we should get going. Good morning, everybody, and thanks for joining us today. For those who don't know me, my name is Mark. Professionally, I'm a lifestyle financial planner. I work with women in finance and their families, helping them better understand what their money can do for them. Personally, I'm a husband to my beautiful wife, Nicole, father to two amazing children, Luke and Sephora. My family is my purpose, the reason I do what I do, and we are on a journey to build our best lives together. And I'm lucky enough that I get to do this for my clients and help them in that regard as well. Our guest this morning is Wayne McFarlane. Professionally, Wayne is the head of benefits at Standard Bank. He's been in the banking world for around 30 years, 20 of those in rewards. He is the specialist in employee benefits and policies and is classified as an advanced global remuneration professional. So who better to talk to us on the topic? Personally, Wayne is a family man who always puts the needs of others ahead of his own. He's married to Charmin. They've got two beautiful children, Brogy and Keaton, who are nearly out of his financial house. Wayne loves everything outdoors. He's an accomplished Ironman athlete, an endurance junkie, mountaineer, and loves international travel. Just some housekeeping. We'll keep the webinar very informal today. We welcome any questions. You can send them through on the chat or the Q&A, and we will address them as and when they pop up, or we'll keep them to the end. There'll be a couple of polls which we would love you to engage in, please. So look, no one's judging you. We just want to get a feel for what you know and what you don't know in terms of the benefits. Yeah, Wayne's going to provide a high-level overview of the benefits and offer to you as a Standard Bank employee. And then I'll offer little insights every now and then on how these can best be used in your personal financial planning. Yeah, so look, we're going to get started. We'll start with the first poll, which is around your pensionable earnings. Marcus, if you can bring that up. So yeah, feel free to answer here, guys. All right, Marcus, how are those responses looking? Wayne, do you want to get going?
Morning, everyone. Thanks so much for taking time out of your busy days to join this session. I'm looking forward to it. Hope there are going to be lots of questions. Hopefully, I'll be able to answer most of them. If not, we'll always send you the responses. So good to see with that poll, everyone knows that you have a choice around your pensionable earning ratio. I think the key thing around the pensionable earning ratio is that it doesn't only impact your pension contributions. So the defaults are 70% for managers, 80% for executives, and 90% for general staff. And then once a year, and we're at that time of the year, in March, you'll be notified that with effect from 1 April, you're able to amend yours if you need to do so, or you can amend it at any time there's a change in your cost to company package. As I say, so it will obviously impact the amount you contribute towards your pension. So typically someone who's contributing 70% versus 90%, they're probably going to ending up with a pension, all things being equal, of about 78% of the person who contributed at 90%. But I think the other key thing for me is that there's an impact on all your risk covers, specifically your death benefit, your PHI, your permanent health insurance, which is for if you're permanently incapacitated, as well as if you've taken some of the optional benefits, for example, like spouse cover. And I think a lot of people don't really understand that differentiation. So, for example, and I will assume everyone on the call has joined the bank since January 1995, when we went to defined contribution from a pension fund point of view. If there's anyone who joined before and is in the defined benefit rules, there's some different rules in respect of that, and I'm happy to answer those. So for those people who are in the DB, they would get a death benefit of 3 times the annual pensionable earnings plus or what's in their share account, whichever is greater. So just to repeat that, 3 times or what's in their share account. Whereas most people, and there's about 200 or so people who are still in the defined benefit rules. The rest of the people either switched to defined contribution or joined the bank after that time. Their life cover is 2 to 8 times their annual pensionable earnings plus their share account. So it's both of those. And how that 2 to 8 times cover works, it's up to 8 times until you age 34. And then it's a slippery slope all the way down to 2 times cover when you get to age 63. And the logic there is that you would be building up your pension as you're working. And so since you get paid both amounts, the life cover quantum will reduce. Now, just by way of simple example, if you're earning R1 million, I'll just use an easy number. So I don't need to use a calculator. And you're on 70% and you're 34 or younger, your lump sum death benefit's going to be 5.6 million plus what's in your share account. Whereas someone who's on 90%, who's chosen the 90%, is going to be on 7.2 million payout on the multiple plus what's in their share account. So it's a significant difference. And similarly, if you sadly have to go on PHI, or as it's also referred to as income replacement, it's calculated on your annual pensionable earnings. So you would get a significantly higher number as a gross payment on PHI. Mark, I don't know if there's anything further you want.
I just want to jump in. So, from what you're saying, from our side, from a planning perspective, we've always advocated, to sort of move up those levels from 70 to 80 or to 90. Yeah. I've normally looked at it from a pension fund contribution, in that, it's a forced savings, it's a fixed savings, and it's going into your pension fund. But the aspect that I've never really looked at, and one that you've highlighted, is the additional contributions. Well, your group risk benefits, which increase as well because of they're based on your pensionable salary.
Yeah.
So that obviously holds, that's quite a good additional benefit to the pension fund contributions as well.
And so essentially, the contributions that people make, it's calculated at 17.5%. And again, I'm going to just speak as assume everyone's in the defined contribution fund. Yeah. Is 17.5% of your pensionable earnings is a deduction out of your cost to company. So that's calculated. 7.5% is the employer contribution, 7.5% is the employee contribution, and 2.5% is for risk funding. So that full 17.5% of either the 700,000 or 900,000 or 800,000 if you're on 80%, assuming the 1 million package, would come out of the person's package before tax, because that's what we're able to do from an income tax perspective. But similarly, employees are also able to contribute up to a maximum of 350,000 in pension fund contributions, or 27.5% of their total earnings in any tax year. Now, interestingly, that 350, when it was introduced, was 6 years ago, and we see now in the budget it's still 350, although they said they would review it annually. Whether they're reviewing it and they're just not moving it, or they're just forgetting to review it, I'm not sure which one it is, but it's still sitting at the 350 cap. And so what we've allowed within the bank is that employees are able to, in any particular month, they can go in and they can actually elect to take up to the 27.5% on SAP ESS. They can go and do it. So potentially someone can do it in October of a year, and then suddenly they know they're paying school fees, and they can then reduce it from, for example, an additional 9% down to 0% or to a lesser percent, and they can do that in any particular month. So I think that's also a great benefit. And I think maybe just one other thing to mention is because our pensionable earnings are only 70, 80 or 90%, and not 100%, someone potentially could still have an RA outside and still be within the allowed maximum in terms of the Income Tax Act. And I didn't say it at the beginning, but I'm not phase compliant, so I may not give any advice today. Mark's the guru who can give you the financial advice, but I should hopefully be able to give you sufficient information to make informed decisions. And I think that's certainly what our role and any HCBP's role, or PNCBP as they're now called, People and Culture Business Partners, should be able to advise.
Wayne, just on that 350 cap, that capping is only, it's a tax deductible capping, right? So you're able to contribute more than 350,000. You're just not going to get a tax deduction on anything more than 350,000 that you contribute.
Yeah, 100% correct, Mark. So for example, the bank has implemented a scheme called the Restricted Equity Fund, the REF, which is for those people in the bank, a very small percentage of them, whose pension contributions annually exceed that 350K. And so the options that they have is essentially one of three options. They can elect the default, which is they will continue to pay monies into the SPGRF and or the flexible executive option, the FEO, which we can also talk about, into those retirement funds. but obviously they'll get no tax break on the amount above the 350. Alternatively, they can say they don't want to contribute anything more above than the 350, and they want the balance in cash. Obviously, that will be taxable. Or alternatively, they can elect to go into the restricted equity fund. So they need to be, their contributions need to be at least 362,000 a year. And the reason for that is they don't want anyone contributing less than 1,000 Rand a month. So it's 1,000 Rand a month times 12 in addition to the 350. So if they're earning 362 or more and they elect to go into that, then they would be able to go into a number of different funds. It's either a local fund or a global fund. It's through Melville Douglas. The administrator we use is Stanlib. And then they would either elect to put those monies into either local or global or a combination. The combinations could be 50-50, or it could be 75-25, either 75 global or 75 local. So there's essentially 5 options for them. The other upside of the REF is that for those people who go into it, they are also able to defer up to 30% of any anticipated performance bonus into the REF before they know the quantum of the bonus. So the people who are in the scheme would be invited typically in October of each year to consider putting up to 30% of any anticipated bonus in. Once they've locked in their request in terms of a rand amount or percentage of the anticipated bonus, they can't change their selection. And the other important point is that the selection in terms of which portfolios they go into in the REF are not constrained, for example, what they've done for the retirement money. So they can have a totally different set of options for the bonus. Unfortunately, though, if people elect not to join the REF, for those people who are eligible, they can't put their bonus in. So I think that from a tax planning point of view is just something to bear in mind.
Wayne, if I can just come in there. So also on the REF, important to note is that the fund selection is not governed by Regulation 28, which the pension funds, FEO and SPGRF is governed by Reg 28. So you've got a greater fund selection in that you could have 100% of the money invested offshore, whereas with your typical pension fund, you can only have, I think it's 30% of it allowed to go offshore. So that's another upside, and I think there is a big distinction between it's not a pension fund per se. It's just, I look at it and say it's kind of forced savings over and above that amount that you're sticking to on a monthly basis.
Yeah, and certainly you're right. It's not a pension fund. It's a share scheme, and so hence, because these are restricted units. And you can't access them, seed them, transfer them, pledge them, or do anything with them whilst you're still an employee. The income tax, any income tax payable would then be deferred to the point when they become unrestricted.
Okay, that makes sense. So yeah, you're basically getting a tax break now, but when you withdraw from the fund, you will incur tax at that point.
Yeah, correct. So I think if we just use the 2 simple options, they're not the default where you're still paying into the retirement funds, taking cash. I think the issue with cash, though, is that people will take the monies, a net of tax, and then they possibly will just spend it, whether it's on school fees or daily living or a holiday, as opposed to actually putting it towards retirement. And so we are going to be doing road shows this month and next month for people who qualify for the REF to show them the kind of difference in terms of whether you go like into the REF or versus cash.
Yeah, I think that's that is a big point. Taking it in cash, you may have every intention to save it independently. But it's because it's independent, it's easier to cancel it if need be, or not to save it. So yeah, I think the RFF is a good option. The FEO as well, from an investment perspective, also has in my opinion, a much wider and slightly better investment option choice. You know, SPGRF, I think you've got 4 options. It's
there 5, yeah, they're actually 5 and 1 default. And interestingly, Mark, that should have been a poll question. How many people are in the default? And the answer is 90+%. And now whether they're in the default purposely because they think that's the right long-term option, or whether they're in the default because they just didn't apply their minds, I don't know what the answer is. But the return on the default option for 2020 was 4.7%. And obviously we know what happened last year, with the pandemic. But the previous year, the default had a 14.7%, exactly 10% more return. So most people are in the default, and you're right. So there are not a lot of options. And you can also switch portfolios once a year at no cost. Thereafter, you pay 375 Rand plus VAT for each switch. Whereas for the people who qualify for the FEO, and essentially you have to put a first portion into the SPGRF, the Standard Bank Group Retirement Fund, and then the balance would go into the FEO. There you have hundreds of options to choose from. And you can go in and switch at whim as often as you like at no charge. So yeah, it's kind of like a top hat scheme. It just gives you a lot more flexibility. Yes.
If Fatima's just asked a question here, how do you go and change your fund selection in the SPGRF from default to the others? How do you do that, and how often are you allowed to do that?
So are you saying in terms of the SPGRF?
Yeah, so doing a fund switch.
Okay. My understanding is you send an email. Fatima, I'll check. We actually have Claudia Worries on the line, I hope. I can't see all the names, but she can maybe just post in the chat. But my understanding is you send an email to the administrator, which is Alexander Forbes, and they then effect the change. So I'm not aware of a time in the year which you can do it. I think you can do it at any time, but you can only do it once a year at no cost. Thereafter, then they do charge you. But the actual process, we can either post in the chat or we can send you afterwards.
Wayne, just on that, what is the default option? Do you know what it's called? Because I know you've got long-term, peer group, stable, money market, and then I think there's a Sharia compliant fund.
Yeah,
it's probably peer group, I would imagine.
Yeah, I'm not sure, Mark. I'm not sure what the default. Sorry, I don't have the list in front of me.
Okay, that's cool, but it's fine. So yeah, I think that that also comes in. Typically when you start out, you get given a whack of paperwork. I remember when I started at the bank, I got a whack, and they told me to select this stuff. I never knew what was what. Just sign and select. But yeah, as you kind of go through your career, these are definitely things you should be paying attention to. Long term, if you're starting out, you ideally want. I think they're risk profiled in a sense. So long term has a higher equity allocation than stable would do. And typically the younger you are and the longer you've got to retirement, you would want more of your funds exposed to a higher equity type portfolio. So these are things from a planning perspective that we would raise on an initial interaction with the client, and then review that annually as you lead up to retirement or transitioning out of the bank for that matter.
Yeah, that seems to make sense.
All right.
I don't know if you want to move on to. I can't see any questions in the Q&A.
It was just Fatima's question on the SPGRF selection. Okay. So yeah, you can move forward.
Yeah, and I think the second poll, Marcus, was on the death benefit, which I think I may have already provided the information, but maybe you want to put that one up now, if you don't mind. I think the horse bolted there because I think I already provided you with that. So hopefully all the people on the call get that one right.
Get it right. Just on that, Wayne, something that I've sort of picked up over the years in doing planning is this number, the between 2 and 8, important to take into account is that is still a taxable amount, right?
100% right. Correct.
Yeah. So it does get lumped with your accumulated pension fund, but important to take into account. Let's say it's 8 times and your salary is R1 million, 8 million, but you're still going to be taxed. And I think it's taxed as according to the retirement tables, if that's correct, because it gets lumped with your pension fund. So it is quite a sizable amount that gets paid over to SARS.
Yeah, so yeah, it definitely is taxable, and it is paid as one amount. So they add the two together. And then for anyone who's on the call, who was in the bank, now I've got to put my thinking cap on because it wasn't on the agenda, but I think it's important to point out to people, if you joined the bank from 1 March 2000 onwards, you have no post-retirement medical aid funding benefit from the bank when you exit, when you retire from the bank. So if you were here before 1 March 2000 and you were in BankMed, then there's an amount that's paid. It's called the provider fund. It would be paid together with your pension contribution when you retire. And then you would obviously utilize it to try and assist paying some of your medical expenses in your retirement years. But for everyone who joined from 1 March 2000 onwards, there's zero subsidy from the bank in respect of any of your medical aid costs. And to put it in perspective, before that date, the benefit was 75% subsidy from the employer. And for the people on the most expensive plan, the Plus BankMed Plus, it was a 65% subsidy. So it was a significant benefit previously.
And Wayne, is that paid as a lump sum, or is it paid as an actual subsidy on a monthly basis?
No, it's Mark, it's a lump sum. It used to, you used to have to go buy an annuity. Now they've just streamlined the process. So when you retire, even if you resign, you would get a lesser payout, and the actuaries would calculate that. So we would apply to Alexander Forbes to calculate the amount. But if someone were to retire, that amount is paid together with their it's lumped in with the pension contribution.
Okay. All right.
I don't know the poll result for that question. Okay, so yeah, no surprises there. Maybe you want to bring up, Marcus, the next poll on the GPA, the group personal accident.
Before you give the answers away again, Wayne.
Yeah, I'm running ahead of myself. I'm trying to remember the polls. I jotted a few notes down.
There we go. What GPA covers in place for permanent employees? GPA, Wayne, what does that stand for?
Group personal accident cover.
Okay. Maybe while that the answers come in, I've always been intrigued by a accidental death cover, right? Does your death need to result purely as an accident, like a car accident, or how do they define accident?
Yeah, look, so I can give you some actual examples. So a car accident is the typical one.
Yeah.
There obviously, if you read the rules of the Standard Bank Group Retirement Fund, there are certain things like one of my hobbies, mountaineering, which are excluded. So, and motor racing, etc. But on the accident side, we've paid out, for example, for someone who was traveling back from doing the Argus cycle race, and sadly they put rocks in the road outside of Joburg, and he got out to move them, and they shot and killed him.
Sure.
So that was deemed to be an accident. We've also had a staff member who sadly was walking past a building site and a bag of cement fell on him and killed him, and that was deemed to be an accident. So yeah, they would obviously look at the circumstances, but essentially accident. Yeah, I suppose it's, yeah, any accident would be looked at, but it's not just vehicular accidents.
Okay.
The only problem with GPA cover, and maybe Marcus, if you want to show the results, so we know whether everyone knows what they're getting. Okay, so 50% of you are right. It's for managers and executives, it's automatically 4 times annual pensionable earnings. For general staff, it's on a sliding scale of 1 to 4 times annual pensionable earnings, and after 5 years, it's automatically 4 times annual pensionable earnings. The problem with GPA is that most of us don't know how we're going to die. So it's not something that you can really bank on, but it's kind of a very nice bond seller, because if you work out what 4 times cover is on those calcs I did earlier, it's quite a big number, especially considering that it's a tax-free payment. But as I say, you're never sure if you're going to get it. But as I say, it's quite a nice bonus, as it were, if that's the way you do go and the payment is made.
Wayne, Claudia's just put some information in here in terms of the switching. So it's 1 free switch per year. Thereafter, all switches after that cost 0.25%, capped at 375. So you can switch once per year. And then I see Marcia's just put something in here. The default life stage model is the default investment portfolio. Yeah, 1 free switch per year. Okay, yeah, that's it.
Okay. I'm glad Claudia and Marcia on the line.
Yeah.
They're obviously closer to the detail than I am. So thanks for that. Yeah, I think the next, maybe it brings us into maybe if you can put the next poll up, I think this is the second last poll, is around incapacity, just to see what people's understanding is, what incapacity benefits the bank has currently. So TTI would be total and temporary incapacity.
And by incapacity, we were referring to a form of disability here. Yes.
So TTI would be, for example, if someone has a mild stroke and they lose the use of their left side of their body, but the prognosis is that after a certain period of time, like a year, they would recover fully and would be able to return to work. And permanent health insurance would be permanent incapacity, where the person is unable to do same or similar job or something in terms of their expertise and experience.
Okay. Marcus, have we got some results there?
Okay, great. Good to know everyone knows we have both. So I'll quickly just cover those two. So TTI was probably brought into the bank 15 or so years ago. And that cover pays for between 1 and 24 months, depending on your incapacity that you have. I would say on average, we probably have at least 100 employees in South Africa who are on TTI at any point in time. And the average time they're off is probably 4 months. But there are obviously some people who need the full 24 months because of the condition that they have. And then hopefully they would be in a position to return to work. If they permanently incapacitated, then we would consider a PHI. But you don't have to go on TTI to then move on to PHI. If you're permanently incapacitated and can't do your job, then we would apply to Momentum, which is an outside insurer, who we have the PHI.
So Wayne, that's important. So the PHI doesn't have a 24-month waiting period.
Yeah, so that's a good question, Mark. The waiting period on PHI is actually 6 months. And typically what would happen is the incapacity panel would manage it so that the person either takes sick leave or some other form of leave, or is on TTI. So when you're on TTI, it's done internally. So we didn't take out insurance premium. It was too expensive at the time when it was launched. And I would say these two benefits are probably the two best benefits I've seen the bank bring out. Initially the TTR, now obviously PHI. I think it's a fantastic benefit, and we'll talk about that. And hopefully none of us on the call ever need to use either of them. But on the TTR, I suppose there is actually a saving to the bank if they're not replacing the person. If the person's off for 4 months, they're paying 75% of that person's cost to company package as opposed to 100%. And so there possibly it could be argued there's a slight saving. But in a lot of cases, especially where the person's off for a long period of time, the business unit would hire a temp or someone to come in. And I suppose the same thing during someone taking parental leave. I'll use the right terminology, and they're off for 4 months or 6 months in the case of some people. Some of those business units may get a temp in also, or otherwise just distribute the work. So I think the important thing just to mention on TTR, if you were to go onto TTR, your case is managed. So it's not like they say, okay, well, there you go, your condition is 24 months. You don't have to come to work for the next 2 years, and then we'll tell you at the end of 24 months that you need to come back. So it's case managed by a multidisciplinary panel. They meet every Tuesday. I've just inherited that, and I went to the panels on Tuesday this week. It's quite draining, and it's quite sad listening to some of those cases. But just on the TTR, when you are on TTR, and again, we'll assume the R1 million package, you then obviously get paid 750,000 Rand over the course of the year. So your income would obviously drop, but your pension contributions would remain unchanged. And that's important, because if something happened to you whilst you're on TTR, you want your death benefits to be calculated using your 1 million package times whatever pensionable earnings you've chosen versus the 750,000 package. So I think that's probably just the one important point. But I'm not sure if there are any specific questions around TTR. If there aren't, then I'm going to go on to PHI. And so this is a new benefit that the bank, or a relatively new benefit, the bank brought in on the 1st of November 2018. So just by way of comparison, what was previously an ill health benefit, or when people are medically boarded, before PHI was brought in, the person would have qualified for exactly the same amount as a death benefit payment. So in my example of someone who was earning $1 million, let's assume someone who's 30 years old, and assume they're lucky enough at that age to be earning R1 million, and they were on a 70% pensionable earning ratio. Their pensionable earnings are 700,000 times the 8 times multiple. They would have got a lump sum of 5.6 million plus whatever's in their share account. And as you rightly pointed out, Mark, that's taxable. And they would have had to invest those monies and live off that lump sum for the rest of their life, which is quite sad. Whereas the difference now with PHI is you don't exit the bank as you would have previously and got a lump sum and had to fend for yourself. Hopefully you went and saw someone like Mark, who could invest those monies properly for you so that you didn't run out of money. But now the PHI benefit is that you would get you would get a net amount monthly, which wouldn't be taxable, from the insurer, from Momentum, and you would then live off those monies, and you would continue to remain an employee until your NRA, your normal retirement age, which for most people in the bank, for the executives on the call, is age 60. For one or two women who members of the pension fund, they are also age 60. But for the majority of employees, it's age 63. You may ask, why do execs go at 60? Well, if you're appointed as an exec or you get promoted to executive level, your NRA is 60 because the bank doesn't want old executives. That's the simple answer. But otherwise,
because their life expectancy dropped as they took on more pressure working in the bank.
Because of the stress. You're right. So that was always the argument I was told. That's why we have an age 60, because there's no exact science for it. But you would remain on PHI until your NRA or until you recovered, if that's possible, which it is in 1 or 2 cases, I suppose, or until your death. So the important point there is you're still contributing and continuing to pay monies into your retirement fund. Again, being able to choose 70, 80, or 90% as your pensionable earning ratio. So again, I can't give any advice, but maybe someone who's on a 90% sorry, let me just, someone who was on a 90%, they may then potentially want to contribute less towards their pension. I don't know, Claudia, you may be able to advise, because the amount you're getting on PHI is a net amount from Momentum, and any increases on that amount are decided by the insurer on your anniversary, whenever you went on. But you would still contribute to the pension fund, and I'll clarify, unless it can be clarified on this call, whether you're able to change your pensionable earnings. I'll backtrack. I'm 100% sure that there's no change possible. So if you're on 70, before you go on PHI, you stay on it. And similarly, if you're on 80 or 90, you stay on those quantums and you can't change it. Maybe Claudia or Marcy, you can just clarify that.
Wayne, can I just ask
you cannot
something on
change.
that?
There you go. Okay, thanks. Sorry, I had to rewind a bit there. But the important thing is that you're still contributing. And so this is an important point. I mean, none of us know if you're going to go on PHI. But if you've chosen 70, obviously the amount you're getting from the insurer will be far less than if you're on 90%. And similarly, the amount you continue to pay towards your pension fund whilst you're on PHI, which you can't now change, will be greater, obviously, on 90 or 80. But I think the important thing is you're still contributing to your pension. You still have life cover. So if you die whilst on PHI, that 2 to 8 times cover will still kick in. And you still are covered by the funeral scheme, which we'll get onto if there's time.
Wayne,
sorry,
can I just ask you something quickly there? So let's say you're on your £1 million and your PHI, is your PHI payment a percentage of your pensionable salary?
It is. There's a formula which could possibly.
Don't stress about it, but
I've got no. There's a formula. So maybe this brings me into an important point, and I think that was the last poll, which we might not even have to put up. And I don't know how many people on the call are aware that we introduced something called the My Benefits app. It's through a company called Benify, a Swedish company, BENIFY. And I know, Mark, you're going to put the detail on how people can download that if you haven't already. Yeah. And so we launched that on the 12th of Feb 2019, 2 years ago. And what you're able to see on that app is not only every benefit you're eligible for, everything we've been talking about this morning, but you're also able to see, for example, your actual death benefit. Now, previously, you would have had to know, firstly, what's your cost to company? What is the ratio that you chose, 70, 80, or 90? Do that multiplication, that's simple grade 3 maths. And then you would have had to go and find the table to see if you were over 34, what is your multiple between 2 and 8 times, and then do that grade 3 calculation. And then you would have got X. Then you would have had to log on to Alexander Forbes and go and get your SPGRF balance, Y, and add the 2 together, and then that would have given you Z, which is the total payout. Now what we've gone and done is we knew what your CTC was. We knew what percentage you chose, and we know what your age is. So I told them just to build a table in the background on SAP, which they've now done. And so now you can go and log on, and you can see your actual death benefit. And it is an approximation because we only used to get the information from Alexander Forbes when it was audited. So at the end of June and the end of December each year. But I had a look this morning on the My Benefits app, and I think mine looks almost spot on in terms of when I looked at the pension amount from Alexander Forbes. So I think it is now trickling in monthly. And this also brings me on to another point. But I mustn't digress too much, because I must remember to come back to your comment around the PHI. But maybe just to talk about the PHI then, is that if you go onto that app, you will see your approximate net PHI value that would be payable in the event of you sadly going on PHI. So I think it's important that you download the app. All the benefits are on there. It's essentially, there's about 80 or 90 pages behind that app. If for every benefit, there's a page, there's a one-liner to tell you what the benefit is. There's a little R symbol. Sometimes you can click on that. It will give you some additional information. If you want more, it just says click here for more information. There are links to wherever that information is contained on the intranet. And then also sometimes you may wish to try and transact by changing or doing something. But those two multiples, I think that's probably the two biggest pluses for South African employees, is that you can see your actual death benefit and you can see your actual net PHI value. And then that just brings me on to, because Mark, you mentioned when we were chatting last about My360. Now, My360, for those of you who are on it, you can obviously see all your investments, including Alexander Forbes and what's in your pension fund. Now, that's a daily feed. And we are in the process, and we have been since last year, trying to get that same daily feed for Alexander into our My Benefits app, so that people will have a more accurate amount of what's coming from the group retirement fund, so that your death benefit calculation is fairly accurate. But again, that death benefit number is a taxable amount, whereas the PHI one is a net amount. But it gives someone a good approximation in terms of what they would get paid, and potentially, and again, I can't give any advice, that's Mark's domain, potentially someone has too much insurance outside and they may wish to review their investments and possibly say, well, maybe I don't need it. Albeit, if you exit the bank, then of course, most of the risk covers fall away. It's only in one or two specific instances where you can extend the cover.
Well, maybe I'll just jump
yeah.
in there. Like,
yes.
What you say is very valid. I think first thing on the app, you know, we've worked with a lot of Standard Bank employees, and 90% of the people don't know the information. So what their PHI is, what their group life cover is, what their pension fund value is, and don't know where to find it. So I think the app is super valuable. I think it's now educating people to use the app, as we're kind of doing here. And then just in terms of that last statement you made, if you don't take these benefits into account when doing your planning, you may go and self-insure outside of the bank, and you know the limits are 75% of your net salary, of your gross salary actually. If you go and do that and pay the independent premiums for that, and then you land up on disability, between the two companies, they're going to aggregate. So your Standard Bank policy is going to pay out their portion, and then your independent policy is going to say, okay, well, you're already getting 75% here. We're actually, we can't pay you the other insured benefit that you've got, which means you're going to have contributed premiums all of that period for nothing. They cannot pay you on disability. You cannot get paid an income greater than the salary that you were earning at that time of taking out the policy. So it is really important to know what you've got with the employer, so you don't double up on insurance on the outside.
Thanks. And I think maybe just the last thing on PHI. So thanks, Claudia. I see in the chat box, sorry, I was having a look at that, that you confirmed you can't change your pension earning ratio whilst on PHI, which we mentioned earlier. So thanks for confirming that. But just in respect of most covers stop. So I had someone who's been in the bank a long time. He said he's obviously was thinking of leaving the bank, and he wanted to know, well, can he continue with his life cover? And unfortunately, no, it falls away. But just on PHI cover, if you exit the bank more than 5 years from your normal retirement age, so it's more than 5 years, then you're able to continue with that cover as a private individual, but obviously at a higher rate. So that is something you could liaise with Momentum in terms of continuing. But most of the covers, the risk covers, the other covers, life cover, the TTR cover, the funeral cover, which I'll quickly mention now because I thought there might be some questions. all of those covers fall away when you exit. And then also just on the funeral, there's two plans. It is a condition of employment, so we have to choose one of the two plans. It's either R5.20 or 11 Rand 50 now for the funeral cover. So it's a very small amount, although some people still bleat about paying it. And also, when you exit and you haven't used it, there's no out bonus. So we don't pay, because that's another common question. There's no sort of refund. And just talking about that, Mark, I forgot to mention just on the coming back to our initial point around retirement funding. So on the 17.5% that we pay on the pensionable earnings that we've chosen, so the 2.5% risk cover, it previously used to be 3%, but they took 0.5% of that and they used that to fund partly fund the PHI benefit, and that's why it reduced to 2.5%. Hence, it's not 18% anymore; it's 17.5%. But of the 2.5%, currently the split is that we get 1.3% back as a risk refundable. So actually, we're not contributing 15% a month; we're contributing 16.3%. Now, there's no guarantee to get that 1.3%, and we've been getting a risk refundable for at least the last 6 or 7 years, and it's been sort of in the order of 1.1, 1.2, 1.3%, currently 1.3%, which means that the other 1.2% is being used for administration costs and payout of claims for death. So we actually are getting a little bit more than the 15%.
Okay. Wayne, we've got 7 minutes left, and there's still a few things. Can you talk to the share incentive scheme?
Yeah, so I think in a nutshell, we got Fatima on the line who runs the share scheme. And so she's actually the expert on the share scheme and the REF. But I suppose, yeah, very quickly and briefly. So that's a scheme, the DBS, the deferred bonus scheme, would be utilized for people who have automatic deferral of their bonus. So these are people who are getting big bonuses of more than R1 million. There's automatic deferral, and those deferrals would be put into the DBS. And they also would have put for sort of high net worth and senior, I should say maybe more senior executives. So senior managers and executives are also eligible for standalone DBS, so for a share incentive award, SIA. Okay. So all of that would go into the DBS, and essentially it's tracking the Standard Bank share price, and the person would then receive, so if they're South African employees based in South Africa, they would receive equal payments after 18 months, 30 months, and 42 months. So, for example, now if someone was getting a DBS award, whether it was standalone or it was a deferral of their bonus, they would land up getting a third of that paid in September next year, and then a following third in the following September, and the last third the following September after 3.5 years. And so I think that's, in a nutshell, is the share scheme.
So if I understand correctly, Wayne, you're saying there's the deferred bonus, which means bonus over a certain rand amount gets deferred into shares.
Well, a certain percentage, a certain percentage of that bonus would be deferred.
Yeah. And
whatever is mandated to be deferred would go into that, correct.
And it's deferred, so it's deferred by way of, we're going to give you Standard Bank shares, which vest on those certain dates that
correct. And then when they vest, you get paid in shares if you're a South African employee based in South Africa. Yeah. If you're an IA or you're elsewhere, or you've spent part of the time, then you'd get, if you're in SA, then you'd get paid for the time. Part of it would be in cash and part would be in shares. But for the South African employees, to keep it simple, they would get the shares, and then it's up to them to decide whether they want, what they want to do with it.
Yeah.
Obviously, there would be tax payable, Mark.
That's what I was going to say. Yeah.
So employers can either fund the tax themselves from their own resources, or they could just, as in many cases, the people would just have the tax deducted, and the balance of the shares would then be paid into their share account.
Yeah, and the tax is important. The tax is PAYE and not CGT. Sometimes that gets a bit confusing because your shares have been awarded on one date and they get paid, say, whatever, 30 months later. You know, you're actually paying a PAYE tax at that point in time, and not a capital gains tax, which reduces the amount quite a bit though over time.
And then there are also dividends. The dividends that are payable and the applicable withholding tax is taken off from those dividends. So people also still get the dividends. I'm just mindful of time. I don't know.
Yeah, we got 3 minutes. Fatima's just confirmed the CGT comes into play at the point of sale in the future after delivery. So I think what she's saying there is, if you've taken delivery of the shares, paid the PAYE, and you continue to hold those Standard Bank shares, at such time when you sell them again, then the capital gains event comes into play there.
Thanks, Fatima.
Wayne, we have 3 minutes. Is there anything else that you want to go through?
No, I think from my side, I'm not sure if there was anything on the agenda that we missed.
Just last thing, actually, from my side, Wayne, is that those funeral schemes, right? They're ridiculously cheap. And from a planning perspective, I cannot find funeral policies for clients. It sounds like a silly thing, but it's really necessary to help the family at the time. And those, is it an option that you can take out at any time, or can you only take it out at inception of your?
No, you don't actually take it out, Mark. It's a condition of employment. It's like belonging to BankMed, the medical aid, unless you're dependent on a spousal partner's medical aid. So you have to take it. And one or two execs in the past have even said that's like, I don't want to pay this amount of money for it. But as you say, I mean, the 11 Rand 50 scheme, you're going to pay to get the same amount of cover, you're going to pay probably between 70 and 100 Rand in the market for that same cover. So, unfortunately, you can't continue with it. And the reason is it's run under license through Liberty, but we do all the administration for it. That's why it's so inexpensive. And also, we obviously just pay out over one amount to Liberty each month, so it's very easy.
Yeah.
So it can't be. So someone may say, well, they've got their private funeral. They don't want to continue. They don't want the Standard Bank one. Unfortunately, they have to take the Standard Bank one, whether they cancel the private one or not, because that's the argument. Well, then I want to take it out when I'm at age 60 or 63. It's expensive. That again is the ball's in your court to advise them what they should be doing. The one thing I didn't mention was the 3 optional benefits that the bank has, but you need to take them out when you join. Is a spouse life cover. Well, within 90 days of joining the bank, we have had a 6-month window period where we relaunched them, which was 2 or 3 years ago. We don't plan to have that again, or if we do, well, then people will have another stab at it. But if you've been in the bank more than 90 days and didn't elect any of them, so it's spouse life cover, it's dread disease cover for yourself, and it's funeral cover for your parents or parents-in-laws. Naturally, if you're single and you get married, then you can bring your in-laws or outlaws, however you see them, onto the funeral plan within 90 days. But that's probably the only alternative option. And then I'm sure for the executives on the call, they are aware that they qualify or they get 350,000 Rand dread disease cover paid by the bank. The bank pays a premium monthly, but they pay fringe benefit on that value monthly.
Okay. Wayne, the last thing on your agenda that you've mentioned here is leave. Is that anything over and above the normal, what you're entitled to, or what did you want to chat about there?
Well, maybe I just thought if there were any questions. Actually, interestingly enough, I think that up to 50% of all the queries the shared services receive is around leave. And that's possibly because every single leave benefit we have in South Africa is better than legislation. But yeah, for managers and execs, they get 25 working days leave. they're also able to purchase, I'll use that term loosely, they're able to allocate out of their cost to company package towards additional days. So it's kind of a salary sacrifice, but they can allocate up to a further maximum of 25 days. And it's not 25, so it's 25 working days. So they could actually allocate, and it's obviously on your daily rate. So the more you earn, the more you're going to pay for that day, but it's pre-tax. So that's an important point. And you can go and do that calc and see on the system how much it will cost you. It's roughly R1,000 per every 250,000 Rand you earn. But you can purchase extra days up to a maximum of 25. So technically you could have 50 days off a year. Yeah, nothing further on leave.
The tough part would be to getting your boss to agree to giving you any kind of consecutive leave that when past 20 days would be amazing.
Yeah, look, I suppose the thing with leave is you're required to take your 15 statutory days each year, and we work on a calendar leave year. We've got that dispensation from the Department of Labor. And so you've got to take it between 1st of Jan and the end of the year, failing which if you don't take it, you have to take it by June of the following year, failing which you forfeit whatever balance or the full 15 days. But then we also allow employees for the additional 5 or 10 days that they accrue, they can save up to 25 days until age 40, or until 100 days until over 40. They can save up to 100 days. Probably the only thing I want to maybe point out, Mark, is if because of COVID, we've actually allowed people not to forfeit their days in June last year. So we're allowing people to take their 2020 leave and leave from 2019 and 2020 until the end of this year. The problem we potentially will have is that if people take all their vacation days, their statutory, those 15 days from 2019 and 2020, by the end of this year, they will have accrued another 15 days in 2021, which they will need to take by June next year, failing which they will forfeit. So maybe that's just one thing.
When you say forfeit, do you mean I lose it completely?
You lose it. Yeah, it gets wiped off the system.
For it?
No, we don't pay you out. You lose it. It's in line with legislation. We don't get into debates. It's system driven. We don't care, what your title is or how much you earn or your age or anything. It's taken off the system. The leave that we obviously would pay out if you were resigning any statutory days that you still had to your credit. But that's obviously a legislative requirement. And then obviously any non-statutory vacation days we would pay out as well on a set formula.
So this, this thing that you've spoken about now, allowing people to take their 2019 and 2020 leave, is that something you're busy dealing with as well?
So that's something we put in place because of the pandemic. So it has increased our leave liability as a result. But we said for those statutory days, those 15 days from that people were going to forfeit last June and would have forfeited this coming June, we've said all the 2019 and 2020 statutory days, those 30 days in total, you as long as you take them by the end of this year, that's fine. But people must understand if they haven't taken any of this year's leave, those 15 days will need to be taken by the end of June next year, failing which they'll forfeit.
Okay. Yeah, I've got a question. So you say failing which I forfeit, but what if I want to apply for leave and I can't physically, I'm not allowed to take it in the sense that...
that's different. Yeah, if you can show that you've applied more than once, and not once, more than once on the system, and your boss declined it on the system, there's a record, then those get reviewed. And I can tell you, I've only seen one of those in 10 years. So
really,
it's going to be forfeited.
That's interesting.
Because normally people will say, but I asked my boss in the passage. Well, now you can't do that because you're working from home, most people. But if it's not in the system, then they don't get considered.
Okay.
So people have to plan accordingly. So I'm glad you actually brought up the leave piece, because it's important that people take leave for their own health. And there's also a requirement that of those 15 days, you take 14 consecutive days. So 14 consecutive calendar days, so that you're out of the office for at least a 2-week period. And now I know people can't travel overseas, but they certainly can travel across borders. They're allowed to go on the beach now. And even if they sit on their stoep, they should be taking their vacation days. You should never forfeit your vacation days.
Yeah, no, especially with this, what's going on in the world, people need the time to recharge, and just take a break from, even with work from home. It may be great working from home, but you know, what conversations we've had, people are finding themselves a lot more stressed actually working from home. There's no boundaries.
100%. Yeah, I don't know if we're working from home or sleeping at the office, but yeah, I think mental illness is on the rise, Sad. And we're going to see a lot more claims from a medical aid perspective going forward. And I think we're going to see a lot more PHI claims as a result. Sad.
Yeah. Look, Wayne, I think we should wrap it there. We're 7 minutes over. Thank you so much, Wayne. I really appreciate your time.
Yeah, you're welcome.
I know you got a lot on your plate, and in true Standard Bank style, they keep filling it up. So thank you. I appreciate it. And for everyone that's attended, thank you so much. We hope we've been able to add some value, give you some insights, how you can best utilize your package and the benefits on offer as a whole in terms of your personal planning. Thank you.
Thanks, Mark, and thanks to everyone who attended, and thanks to my team who posted some of the answers. I appreciate it.
Thank you, guys. We appreciate that.